Good afternoon, everyone, and welcome to this webinar hosted by Satrix and Sanlam Investments. During the webinar this afternoon, we will take you through some indexation strategies in South Africa. We will test some of these strategies against their benchmarks and what they are the intent to do, and specifically when you consider them as part of building a portfolio. And then we will hopefully showcase during this afternoon why you should actively consider passive strategies or index tracking strategies when you provide advice to your clients, like the webinar's title says. Before we get there, my name is Kingsley de Swart. I head up the retail distribution function at Sanlam Investments, and I will be your host during this webinar this afternoon. A couple of house rules. Firstly, as participants, you will be only able to engage with us by utilizing the Q&A button in the middle of the bottom of the screen. You will not be able to engage with us via audio or video. And then secondly, we'll be running some polls during this conversation this afternoon. Please feel free to provide your honest feedback, as it gives us nice and good information to utilize when we engage with you as clients afterwards. This afternoon, our presenter will be Kingsley Williams. He's the Chief Investment Officer at Satrix. I'm not going to do a long introduction for Kingsley. I think he's well known in the industry. He joined the Satrix business in November of 2017. He's got a wealth of knowledge and experience in this area of investments, more than 20 years track record. Kingsley, without much further ado, I'm going to hand over to you to take us through the presentation, and then you and I will engage afterwards during the Q&A. Good afternoon, Kingsley.
Hi, Kelly. Thanks for the introduction. I'm just going to see if I can switch my video on. Seem to be struggling there. I don't seem to be able to switch my video on, unfortunately, but let me share my screen and I'll get going with the presentation. Thank you very much for that introduction. Let's just see that you can all see my screen. I trust that's coming through.
Yeah, we can see it. Thank you very much, Kingsley.
Okay, excellent. So, yeah, the title of my presentation is, are you actively considering indexing and indeed a smarter indexation strategy? And you'll see why as I get into the presentation. So, as part of considering this question, a criticism that is often leveled at index funds is they are guaranteed to underperform. And so in response to this question, are index funds guaranteed to underperform? The answer that I would propose to this question is, well, it depends, and relative to what? So while it is true, because of costs, that index funds will typically underperform the indices they track, this may lead you to draw incorrect conclusions if this is the only question you ask. So allow me to introduce you to Bill, or more formally, William F. Sharpe. You'll have heard of the Sharpe ratio, which is named after him as a measure of risk-adjusted returns. Sharpe is in fact the winner of the 1990 Nobel Prize in Economics, more formally the Nobel Memorial Prize in Economic Science. And he was one of the originators of what we now know as the CAPM, or the Capital Asset Pricing Model. He also published a famous article in 1991 called The Arithmetic of Active Management. And that's a very fancy title for a concept which is actually quite simple. What exactly is the Arithmetic of Active Management? Well, very simply, it states that for every dollar or rand that outperforms the market, here on the right, there'll be another rand or dollar that will underperform. So essentially, amongst all market participants, it's a zero-sum game before costs, and that's the important aspect. The market benchmark, which is a weighted average of all the securities within the market, as illustrated by that blue bell curve, will represent the average of all investors in the market before costs. So that's quite simple. And as you'll see, the market benchmark is indicated by the dotted line in the middle there. However, in practice, investing and investment funds incur costs. All of them do. And this shifts the distribution of returns to the left, as indicated by the light blue bell curve there. The average or median manager now underperforms the market benchmark, which actually only leaves a minority of managers that actually outperform over a given time period. And that's what I've illustrated there in the orange section there. These are the minority of managers that would actually outperform the market benchmark. So while it is true an index fund will also underperform the market benchmark it's tracking because of costs, to the extent that an index fund is more cost effective, it should consistently outperform the average or median manager over here. So in essence, charging more can't beat an average of the same thing which charges less. And that's very simply what the arithmetic of active management is all about. So a question which I think is a better question to ask and answer is, are index funds an attractive investment proposition? And relative to any other fund that you have the option of investing in, do index funds make for a compelling or attractive investment proposition? Now, before we continue in answering that question, let's kick off with the first poll. Gili, are you able to bring that up?
It should come up now, Kingsley. But continue so long. There we go.
There we go. So the first question I have to ask is, what is your preferred South African equity benchmark? And I've given you 4 well-known all-share indices there, the All-Z, the CAPI, the SWIX, and the CAPSWIX. But if you use others, you can tick the other box as well. We're not going to analyze the results just yet. We'll have a look at those at the end. So please complete that as I carry on presenting. All right, so to answer that question, we first need to create a long-term return series representative of what an index fund would have delivered after costs. We've used the CAPSWIX, which is our most diversified broad market index, and that removes any concentration risk concerns on particular stocks. And we've deducted 50 basis points per annum to represent the management fees and tracking error of an index fund on a net of fee basis relative to all the other unit trusts in the retail category. Now, after removing all smart beta or index-based funds, we compare this performance to the average of all South African general equity unit trusts, essentially an active fund proxy. So the light blue line represents all the general equity funds in the South African equity general category, excluding any index funds, so as well as smart beta funds from that set. So we're looking at the average of active fund returns. It also includes funds that have been closed or merged during this period, so that we deal with the survivorship bias that is often prevalent, when looking at historical returns. Now, to get a better handle of how the index proxy has performed relative to the active funds, what I've done is I've included the cumulative difference between the two, and that's indicated by the gray shaded area. Now, at first glance, it may appear that the index fund has actually only started outperforming since April 2014, over here, when the cumulative returns turned positive. The reality, though, is they have actually been outperforming since the beginning of 2005 or the end of 2004, which is a 15-year, over 15-year period to the end of April, and essentially have clawed back the underperformance that they were initially incurred relative to active funds in the first 3 years. In fact, they've outperformed by, on average, 1.3% per annum over this period. Now, more recently, active funds have actually started outperforming once more, and you can see that in this gray line with the slope trending downwards again, and then sharply so with the correction in the market in March. And this is really a function of, particularly South African Inc. stocks, which the CAPSWIX has higher exposure to struggling in the midst of our tough economy. But it's important to remember that SA general equity unit trusts may also have up to 30% exposure to offshore investments, whereas obviously our index proxy is limited to stocks on the JSE alone. And I'm going to unpack that a little bit further for you in a moment. So to illustrate this, you'll see that what I've plotted here in purple is the MSCI World's returns in rands. And from this period here where index funds, the index proxy started again losing value relative to the average of active funds, you'll notice that MSCI World over that period has delivered a return of 25.4% since it's about March 2018. Now, over that same period, the capped wicks after costs was down 8.5%. So our market retreated by 8.5%. And that, this fact alone would explain the almost 4% difference between index funds over that short period versus the average of active funds. So if we had the ability to compare apples with apples over the recent past, index funds would have done better relative to local only active funds, which can also be seen in more offshore focused indices like the ALSI and the CAPI, which have continued to outperform the average active fund by between 1.3 to 2.7% over this period here indicated by the arrow. So what's also interesting to note, though, looking at this long-term chart, is how investing offshore hasn't been a guarantee to delivering increased returns, even with the additional tailwind of a weakening rand. So even if you ignore the initial period where MSCI World significantly underperformed our market, and that was this period over here up to March 2003, if you ignore that period, you would still have been better off with our local market after costs by more than 64% cumulatively, or 0.5% per annum. So in other words, our local market would have still outperformed investing offshore, despite the significant performance that we've had from offshore investments in rands more recently. So time to ask you another question. You can pop up the next poll. And while that comes up, I want to ask the next question, which is traditional active management an attractive investment proposition? And the poll for you to answer is, what are your primary considerations when choosing funds and constructing portfolios? So you can select you can select 2 or 3 options in this in this poll, and we'll have a look at the results at the end. Okay, I'm going to carry on with my presentation while you answer that. But to get a better sense on answering that question, is traditional active management an attractive investment proposition? What I'm going to do is move into relative space. So I've plotted cumulative returns on the previous slides. What I'm now doing is moving into relative space relative to our capped SWIX index proxy on a net of fees basis. And that's indicated by the zero line axis here in black. So all the lines plotted on this chart represent 3-year rolling relative returns, or alpha, relative to the capped SWIX index proxy after costs. And what you'll notice is that you would have had to quite consistently invest in a top quartile performing active fund, as illustrated by the orange line, just to be in line with the capped SWIX index fund. And that's obviously quite a tough job, to say the least, knowing which of the 220 funds that have been in existence over this period would have been top quartile performers at various points in time. And so you'd need to have consistently chosen a top quartile performer to essentially deliver performance in line with what the capped SWIX index proxy has done. Now, there are obviously notable exceptions. There's this period right at the beginning here where we saw pretty much all active funds outperforming the index proxy, and there were various reasons for that. And then obviously more recently, we see that active funds have done better over the last few years relative to the capped SWIX in particular. and I'll unpack that for you further. So, assuming you could predict what the most successful funds would be, and by the most successful funds, I mean those attracting the most assets, would this have helped you in achieving top quartile performance? So the most successful funds in our market, I've plotted them here in the gray lines, have been quite erratic and inconsistent in delivering alpha. So what you may do, assuming you could have identified these funds, was to create some sort of blend. If you were to identify these funds 10 years ago, for example, you would have created a blend amongst them to enjoy the performance of these most successful funds. So I'm going to plot what that blend looks like in the purple line. And what's quite interesting is that had you had that perfect foresight and were able to successfully predict which were going to be the most successful funds in attracting assets, and created an equal weighted blend of those funds, then you would have been able to achieve quite consistently top quartile performance. You can see that the purple and the orange lines are quite similar. But remember, this would have largely been in line for most of the period that we're looking at here, relative, would have been mostly in line with what the CAPS-Wicks index proxy has delivered, barring the initial period and the more recent period at the end. In reality, though, most of us would probably have chosen our active funds from some time ago, and are unlikely to have been lucky enough to choose the most successful funds. So what I've done now is I've taken the largest 10 funds from 10 years ago. So what were the most successful funds 10 years ago? And what you'll see is that the variability in their returns is a lot wider than what I showed you on the most successful 10 funds currently. And so the alpha they've been able to deliver hasn't been anywhere near, as erratic as the alpha was on the 10 largest and most successful funds now, the largest funds from 10 years ago, their alpha has been even more erratic. So assuming you created a blend of those funds from 10 years ago, that were the largest 10 years ago, this is what their average performance would have been. And you can see quite consistently below the top quartile. At some stages, it's been around the median, particularly in this period here. More recently, it's had some top quartile performance, but it's lagging the top quartile again right here at the end. And so, even active funds obviously do deliver alpha, as is clearly shown in my charts here, and they obviously play an essential role in price discovery as well as keeping the market efficient. But the problem we're faced with as investors is because there is so much choice, it is extremely difficult for investors and indeed their advisors, such as yourselves, to consistently choose the minority of active funds that do outperform an index proxy. And I just wanted to show you another example of how difficult that can be. What I'm doing now is, instead of using the CAPS-Wicks as an index proxy after fees, I've just changed the index now to the CAPI. And the CAPI has got a slightly different weighting scheme to the CAPS-Wicks. We can discuss that more at the end. But you'll see that more recently, it's performed significantly better and has been basically a top quartile performer relative to any other active fund in the market, and has done obviously a lot better than what CAPS-Wicks has delivered. So essentially, any managers that diversified offshore or went overweight on resources rather than SA Inc. stocks, are likely to have been very well rewarded relative to a CAPS-Wicks index. It also, I guess this just also highlights that there is no such thing as passive investing, as even the choice of which benchmark to track is a very active decision, and albeit a much simpler one than choosing amongst the 169 equity or active equity funds that are currently in existence at the moment. So I think that's quite an interesting result, and the results, the results in terms of the success of active funds can vary quite widely depending on which index you choose to track. So let's ask this question. Is there a better way to deliver excess returns apart from having to choose amongst the myriad of different strategies and active funds available in the market? And I'd like to introduce the concept of factor investing. We particularly like the concept of factor investing because we believe factors drive a significant portion of the excess returns available in the market. I've chosen 3 factors here: quality, momentum, and value. These are indices that we calculate and have money invested tracking these indices. And what I've done is plotted their performance over a long period of time. And you'll see that they've all added alpha relative to a broad market index such as the CAPS wicks. In fact, they've delivered between 1.6 to 4.1% per annum relative, in excess of the market over a long period of time. But what's more important about how factors behave is that they capture unique drivers of excess returns. And because those unique drivers occur at different times during during market cycles, the factor strategies outperform at different times during market cycles. So what this chart plots is the excess returns of our momentum index versus CAPS wicks on a rolling 1-year basis. So each point on this line represents the previous 12 months worth of returns, and whether those returns were in excess of the CAPS wicks above the axis here, or whether they underperform CAPS wicks if the blue line is below the axis. Now, I'm going to add some other factor indices, the value and the quality indices that we track. And you'll notice that, let's have a look at the light blue line, for example, which is value. Value tends to outperform when momentum struggles, as you can see here during this period in 2016, and vice versa tends to underperform when momentum outperforms. So value and momentum tend to be negatively correlated with one another. And then with quality, you'll notice that sometimes it outperforms when momentum's doing well, sometimes it outperforms when value's doing well, sometimes it outperforms when neither's doing well. And so we find with quality that it tends to have very low correlations relative to momentum and value. But it is in its own right a unique source of excess returns in the market, as has been researched by academics and tested globally. So it also makes for a compelling case to include into a portfolio as a source of excess returns. What you'll notice is that very few, when one factor is underperforming, it's generally counteracted by the other 2 outperforming at that particular point in time. And very seldomly do 2 of these factors underperform simultaneously. But when they do, it's often counteracted by the other factor outperforming quite strongly. So it makes for a compelling case to include a blend of these factors. And so what I've done here is just simply taken an equally weighted blend of these 3 portfolios or these 3 indices and created a factor index blend and plotted its performance relative to CAPS wicks. And you'll notice that how consistently this blend outperforms the market. You notice how consistently it's above the 0 axis line relative to the few times when it is actually under the 0 line. In fact, it outperformed the CAPS wicks on a rolling 12-month basis at each monthly point, 87% of the time over this period. So very, very consistent outperformance. And this is purely because you've blended different drivers or sources of excess return, which are either negatively or lowly correlated with one another. And this is what gives rise to this more consistent outperformance relative to the market. So the question then that I'd like us to address is there a better way to access multi-factor investments? Should we be blending different strategies together and have control of that decision as investors, or would we prefer to outsource that decision to our investment manager? And this is actually a question which should pop up as a poll question for you to answer. and I'm going to elaborate on that question further in this next section. So you can respond to that poll when it pops up while I continue with the presentation. Okay. So I'm going to introduce to you what we call SmartCore, or the Satrix SmartCore Index. And this really underpins the equity strategy that we use within our Satrix Balanced Index Fund, which you may have exposure to, and is in fact now also offered as a standalone equity unit trust. And it's our flagship way in which we target excess returns. So just to explain how SmartCore works, I showed you a very simple scenario of equally blending 3 single factor strategies together. Now, when you blend those single factor portfolios together, you'll end up having exposure to all the stocks across those 3 factors portfolios or factor indices, essentially the union of those 3 sets. So you'll see all the dots within each of these circles. You know, the dots within the quality circle represent quality stocks, the dots within the value circle represent value stocks, and the stocks within the momentum circle represent all the stocks within the momentum index strategy. And if you created a multi-factor blend by blending those 3 sub-portfolios together, you would have exposure to all of those stocks. However, the challenge is that a strong value portfolio may have stocks which have very weak momentum or quality scores. And I've indicated those with these gray or black shaded dots on the outside here. And the same would exist with a momentum portfolio. It might have very strong momentum stocks in here, but some of those strong momentum stocks would have, you know, very poor value or quality characteristics. And so those stocks which offset the quality or value or momentum characteristics that we're seeking are the ones which we then look to exclude when we construct SmartCore. So what we do is we create an aggregate score across all the stocks in our universe, across value, quality, and momentum dimensions. And those are the stocks that we typically target. And we construct SmartCore by calculating an aggregate factor score for each of those stocks in our universe. And then what we do is we also risk control that relative to a parent index such as CAPS-WICks. So what that ensures is that the SmartCore remains well diversified. It remains cognizant of what the broader market is doing, and remains well diversified in both absolute and relative terms. We also manage and explicitly manage a variety of other risks in that process, you know, in addition to tracking error, to ensure that the equity strategy is very well diversified. So that's a summary of what SmartCore is. It's not blending 3 single factors together, but instead constructing a multi-factor portfolio by targeting the stocks which have the best value, quality, and momentum characteristics in aggregate, and risk controlling that relative to CAPS-WICks. Now, the reason we do that is we can construct a multi-factor portfolio from the bottom up instead of blending single factor portfolios. So we do that so that, the reason we do that, it's important we understand what each factor strategy in a single factor context is providing. So if we look at our Satrix Momentum Index, it only targets the momentum factor. And as such, you'd expect it to have strong momentum exposure, as illustrated by the blue bar here. But what is quite typical within a momentum portfolio is it has negative or low exposure to value characteristics, as evidenced by the light blue line representing the value factor, as well as the yield factor in the orange line. Those typically go hand in hand together. And so I'm going to show you what the factor exposures are of our value and quality indices. These also target single factors, and our value index has positive exposure to value factors, as you can see there, although negative exposure to momentum. And then profitability is a measure of quality, one of the measures of quality, and you'll see that our quality index, our S&P quality index, has strong profitability exposure, tends to go hand in hand with dividend yield. That's also a characteristic of quality. but negative value exposure coming through there. So if we blend these three strategies together, these single factor strategies together, this is the resultant factor exposure. And we would typically say that, you know, this is a Z-score on the left here relative to caps wicks. And if a investment strategy or a portfolio has a Z-score or an exposure to a particular factor of 0.2, that would be deemed significant or material. Similarly, if it had a negative exposure of minus 0.2 to a particular factor, that would be significant negative exposure. And so you can see that the blend does indeed have positive exposure to the factors we want, but it's not terribly significant. It's below the 0.2 level. With Smart Core, because we have more degrees of freedom to play with by choosing amongst, you know, the 160 stocks in our universe to gain that factor exposure through, as well as ensuring that we limit exposure to the stocks that have offsetting factor exposure, we can enhance the exposure of the overall portfolio to the factors we are interested in. And you can see that coming through in the exposures of Smart Core relative to an equally weighted blend of these three single factor indices. The other reason that we construct our multi-factor index this way is we are able to maximize the factor exposure within a given risk budget. And I guess it's important with factor strategies never to lose sight of the relative risk that you're taking within that strategy. I'm going to wrap up now in the last section. Remember this chart and how well a vanilla, well-diversified index fund such as a caps-wicks fund does relative to active funds after costs, pretty much for long periods of time, giving you top quartile performance relative to any of the other funds that you may be considering. And if you had perfect foresight to predict which funds would attract the most assets, i.e. the largest 10 funds now, a blend of these through time would have delivered top quartile performance. The purple line is very similar to the top quartile orange line in this chart. But in reality, most of us have probably chosen the funds we're currently invested in from some time ago, which, you know, if you created an equal weighted blend of those, would have underperformed the top quartile and obviously underperformed the index proxy by some margin and for extended periods of time. So this is what Smart Core has delivered through time. It's obviously a single fund, so it's going to have variation relative to the market. It will go through periods of outperformance and underperformance like any fund will. But it offers a compelling way to achieve excess returns above the index proxy and after costs. What is particularly pleasing to see is how well this fund has done with real money behind it since September 2018, which is when this strategy was adopted within the Satrix Balanced Index Fund, and is now obviously also available as an equity-only unit trust. So normally when you run these back tests prior to September 2018, in fact, prior to July 2018, the index was back tested. We've deducted costs to represent what the experience would be on an after cost basis. So we're comparing like with like. What you typically find with back tests is that you see great performance on a back tested basis. And then when you start running real money against that strategy, it doesn't always deliver the same kind of outperformance that you were expecting on a back-tested basis. We've actually experienced the opposite with seeing some of the largest outperformance that this strategy has delivered over this entire period coming through off the back of live money that we've actually been managing against the strategy. So that's very pleasing to see. So to wrap up, index funds obviously make for a compelling investment proposition. They make sense because of the arithmetic of active management, which I explained right at the beginning. But it's also important to remember that active funds play a vital role, and any calls that active funds have made to diversify away from SA Inc. stocks and into offshore as well as into resources, is likely to have been well rewarded relative to a CAPS-Wicks index. However, for investors benchmarked against ALZ or CAPI, the value add that's been delivered from active funds has been muted to negative over the more recent period. And then finally, factors drive a significant portion of excess returns and are also cyclical as well as counter-cyclical with each other. So combining factors together into a multi-factor index like SmartCore has shown to be a powerful way to deliver excess returns, firstly. Secondly, to generate a smoother and more consistent journey to achieving those excess returns. And finally, it allows you as the investor to enjoy increased cost benefits and greater confidence in your fund's investment strategy. So with that, I'd like to thank you, and particularly thank you for any of you that have investments in our funds. It's because of your support that Satrix, in its 20th year and its 20th birthday this year, is one of the fastest growing managers within our market. And we now have assets in excess of 90 to 100 billion rand under management. It's because our business has scale and is sustainable that we look forward to the next 20 years in helping you and your clients own the market. So with that, I'll hand back to Gili. I think there are a few other questions and polls that we'd like to run, and then I'm happy to take any further questions that there may be.
Thank you very much, Kingsley. Alison, can you just assist? There we go. There's Kingsley. How are you doing? All right. Yes. So, Kingsley, my disclosure to our presenters normally would be that these questions don't come from me. So we've got a very active crowd this afternoon. Once again, I'm going to pose you the questions as they come up. And I'm going to try and do a combination between, covering some of the questions and combining it with the polls. So, I mean, let's start off with the first polling question. It was around choosing your SA equity benchmark. I mean, I'm not going to ask you what you think the results should be, but I mean, 63% of our participants this afternoon indicated that it's the all-share index. Is that a surprise to you, or would you expect to see something different?
It's a little bit of a surprise to me. It's a yes and no answer to that question. I think it's fair to say that most investors are more familiar with the all-share index than something like the CAPS-Wicks. And, certainly over the last 18 months or 3 years, they've been very well rewarded by being all-share cognizant, if I can put it that way, relative to something like CAPS-Wicks, which has a much more of an SA Inc. focus in its exposure. We also find that CAPS-Wicks has more of a financials tilt than something like the all-share. But one of the criticisms that is leveled against index funds is that you also run a lot of concentration risk, and that would certainly be the case with an index like the all-share, which isn't a capped index, so it has higher exposure to companies like Naspers and Prosus together, which obviously all linked to Tencent's valuation. So, for investors that are concerned about that stock-specific risk, CAPS-Wicks does provide an alternative, and we do offer both all-share and CAPS-Wicks index funds in unit trust form, but we can track other variants in the segregated mandate form, such as the CAPI, but we don't have it as a unit trust per se.
Yeah, I must be honest with you. I was also surprised with the result because a lot of the active fund managers also started to move over to CAPS-Wicks as the benchmark for the exact reasons that you just mentioned. But let's combine it with another question that we had. Now, you mentioned the CAPS-Wicks and you gave a high-level idea of what the index is all about, but how does the CAPS-Wicks and the CAPI compare to each other now?
Yeah, so that becomes quite a sort of a technical discussion. So I'll try and keep it simple, but I can't remember the date exactly, but it could have been 2011 where some companies that were locally listed took their primary listing offshore. These would be companies like Anglo American and BHP Billiton that were available in our market, but they took their primary listing offshore. Now, those companies were then deemed what Treasury and the Reserve Bank, they deemed them grandfathered companies. So essentially, they were eligible for inclusion into our indices at their full market cap weight. But any companies that followed the same route and went to list offshore or had a dual listing in South Africa got treated differently. So basically, those companies that went offshore prior to, I think it was 2011, they're included in the all-share index at their full global market cap weight. So you'll find that the CAPI has a higher weight to stocks like BHP Billiton and Anglo American than you would find within the SWIX, because SWIX downweights them to only consider the shares that are domiciled in South Africa by, the shares that are listed on our local register. So it's a bit of a technical reason, but essentially the SWIX mirrors more accurately what investors in aggregate are holding locally than something like the ALSI or the CAPI, because those indices include the global free float of those dual listed companies. Obviously, there's no difference in terms of maximum weight. They both cap out stocks at 10%. So you'll find that, at each quarterly rebalance, Naspers is capped at 10% in both the CAPI and the CAPSWIX. But it's the other stocks that are different. And so you'll find the CAPI has a higher weight to resources, for example, which, given their performance over the last few years, would have boosted the performance of that index. But remember, resources, and in fact all the sectors, are cyclical. So they go through periods where they do really well, and then they go through periods where they underperform.
Okay, so now I think if we posed question number 2 a couple of years ago on what's your primary consideration when you choose to allocate to passive or index tracking capabilities. I mean, number 1 would surely have been costs, and it's always about cost. It's cheap and all those type of things. But I think you'll be too happy to get the feedback that actually the factor that they look at most currently is the style of investing and the factor exposure, and then second and third is the performance track record. I think that's obviously a logical second place, and then philosophy. I mean, so is that an indication of that the people are getting more familiar with what index tracking capabilities are all about, and also that they almost look at it similar to doing a due diligence on any other active manager at this point in time?
It certainly sounds that way, Philly, and I hope that our message in the market around considering the real drivers of excess returns being originating from a factor perspective, hopefully that's starting to resonate with investors, and investors appreciate the styles that underpin what gives rise to a particular manager's outperformance or underperformance over a particular period of time. So that certainly sounds very encouraging, and obviously from a factor perspective, I think the fact that a factor index systematically stays true to label regardless of the economic condition or the market cycle we're in provides a lot of certainty for investors and confidence for investors when they choose to incorporate those types of strategies into their portfolio, because there's a lot of confidence that it's going to remain true to its stated style because it's run that way. So that's something to bear in mind when choosing different factors or different portfolios or different funds to blend into your portfolio, is to make sure that that those funds continue to behave the way that they were initially marketed to you and the reasons you went into them in the first place.
Yeah, and I think that's very important because we've got a question around that as well. And I mean, it's probably maybe a very difficult question, but I'm going to pose it to you in any case. So, I mean, you say, or you mentioned that, the factors or index tracking capabilities, they do stay with, the original way of what they intended to do. But now there's this question around, there's this perception in the market that when markets go down or we go into bear markets that, passive and factor type index funds will always underperform. And the question is, firstly, what's your view on that? Is that true? Generally speaking, I know it's a very loaded question. And then secondly, are we saying then if it's very difficult and in bear markets, they should generally underperform. Should our investors then tilt away, in and out of bear markets when it's going into a bear market, tilt out of the index tracking capabilities, and when, the market's running and you tend to get this bull market type of conditions, then tilt into these capabilities again?
Yeah, I think that's always looking back at performance, that's always the holy grail, to say, that would have been the perfect time to switch, away from more sort of pure beta type play where I'm fully exposed to the market into a more defensive strategy. But obviously the challenge is calling that in advance. And I think the massive volatility we've seen in February, March, with the market selling off close on 40%, and then almost bouncing back in April, May, almost back to the levels we were at in mid-Feb. Who could have predicted that, or who would have even got that call right to say, okay, the market's down 40%. This is when active is outperforming. Now I'm going to switch back into index at that low point because now the markets are rallying again. It's incredibly difficult to do, and timing the markets is next to impossible. So yes, it is, and hopefully what I've elaborated in some of the analysis is that it does appear that active funds do better when there is a severe correction in the market. The results clearly show that. But it's important to unpack the reasons why that may be. And hopefully, as I explained in the presentation, when in the SA general equity context, managers are able to invest offshore themselves up to 30%. So that certainly any offshore exposure you had during the more recent market turmoil would have significantly helped you because of the rand weakening. That would have been a massive boost to your portfolio. But by the same token, we see whenever the markets go through those corrections, and the rand typically blows out as well during those times, what happens is it recovers as it's doing now. We're seeing the rand recovering quite strongly. It's down in the 16 levels at the moment. It was up at 18.5 not so long ago. So, and that coincides with our local market doing well. So those managers that have got that offshore exposure, they're going to be feeling the pain of those offshore investments being devalued in rand terms because the rand is strengthened.
So obviously, our participants indicated that they look a lot, at factors when they do allocate. So I think there's a couple of questions I would like to explore further. And the one is, you touched on smart core, and you basically said that you construct the smart core from the bottom up. Why would you do that instead of just blending some of these factors? I know you mentioned it, but maybe it's worthwhile just to reiterate it to our participants.
Yeah, the primary reason for doing that is starting with a risk budget in mind and making sure that, and by risk budget I mean how much of your tracking error relative to the broad market are you going to use, and are you able to maximize the factor exposure that you ultimately want within that risk budget. Now, we start from that frame of reference, which constructing it from a bottom-up perspective enables us to get much more factor exposure per unit of risk that we take, per percentage of tracking error that we take relative to the broader market. So that's the primary reason we do it. But also, doing it that way ensures that we limit the unintended consequences of blending different factor strategies together, where there's a lot of offsetting characteristics that take, offsetting factor exposures within the single factor portfolios, which ultimately dilutes the factor exposure that you can get. But the primary reason is that you can more explicitly manage your risk, and then obviously make sure that you maximize the factor exposure per unit of risk that you take. So it's a cleaner way of doing it, and make sure that you're not introducing any other unintended tilts in your portfolio relative to the market, or unrewarded risks relative to the market.
Okay, so people investing then in something like the smart core, can they always expect the smart core to outperform, other solutions rather than going to blend their own type factors themselves?
Yeah, so I'm nodding, but that's not a nod to say it will always outperform, just to be clear. So our view would be that if you believe in factors and you expect factors to outperform long term, then having enhanced exposure and consistently higher exposure to those factors in the form of smart core should, over the long term, give you higher performance than blending single factor strategies together, because it's the factors that are driving the outperformance, and so you want within your portfolio greater exposure to those factors, which over the long term should give you higher outperformance. The caveat to that, though, is that factors are cyclical, and there will be times when one or two of those three factors, maybe even three, it's unusual, but there could be times when factors go through periods of underperformance, or maybe the one particular factor really underperforms the market and isn't, the outperformance from the other two isn't enough to counteract that. So because you've got enhanced exposure through smart core to those factors, if one or more of those factors underperform, you would expect smart core to also underperform more than a factor index blend which has less exposure to those individual, to those factors collectively. So it really depends at a particular point in time what's playing out in the market. But over the long term, if you believe in factors outperforming and delivering excess returns, smart cores are the best way to achieve that, and should give you an edge relative to blending single factors.
Yeah, and I think it comes back to that comment you made, earlier about factors going through cycles, performance. But I think the most important thing is, from an investor point of view, make sure which factors you've got exposure to when you do allocate, and then that you are aware of what these factors could and should do during different market cycles. Am I right?
Yeah, exactly. And I guess that's part of the value add of smart core is that. It hinges on the research that we've done within Satrix on which of the factors in the South African market show the strongest, long-term excess returns within the market. So that's specifically why we target momentum, quality, and value. It's not to say there aren't other factors which deliver excess returns. Size is another one, and low volatility can be used in different contexts as well to achieve specific outcomes. But we really like quality, value, and momentum in terms of the excess returns that they deliver. And our research has certainly shown that, combining those three really creates for a solid value proposition.
Yeah, being cognizant of time, I don't want to spend too much time. I mean, I can see some of the people are getting itchy to we are starting to see some of the participants already logging off. Maybe one or two questions more. Kingsley, why did you select the CapSwix as the benchmark for smart core, no other equity index?
Yeah, it's a good question. It really hinges on what we see as the primary benchmark that institutional investors use, and CapSwix plays a role in the institutional market as well. Even though it's available within our balanced fund, it's the equity strategy within our balanced fund, and it's available as a standalone unit trust. It is used by institutional investors, and CapSwix has generally been accepted as the de facto or default institutional benchmark. So it's a logical place to start. We've also done some further research on the different indices, and CapSwix is certainly the most well-diversified benchmark relative to the other three that I mentioned, ALSI, CAPI, and Swix, the uncapped Swix. Because of the way it's constructed, the fact that it has less exposure to resources which tend to be more volatile. So it's the most well-diversified index, and it gives you a nice base against which you can express your factor tilts. Because you don't have, if you took an ALSI index, for example, or a Swix index, for example, you've got massive weight in the largest shares, which limits your ability to go overweight if you were very positive on those shares from a factor perspective. But it also limits your ability to go underweight on the smaller shares if those were unattractive from a factor perspective. Now, because CapSwix is more diversified, you've got more levers to play with from a factor tilting perspective. You can go overweight on your larger shares because your base is capped out at 10%. And similarly, you've got larger weights down in the tail, which gives you more room to go underweight. So that's some of the reasons why.
Okay, last question, and if I'm going to give you an out on this one, if you think we need to answer this individually to the person who asked it, I'm going to give you open the back door for you. But the question is, if you would like to blend the size factor with the smart core, what I mean, obviously you guys considered it. What would that blend be? And can you actually answer that question right off the bat, or should we do some work on that and come back to the person who answered or posed the question?
Yeah, so there's a couple of ways to access the size factor. I'm not going to take your out card, Gili. I'll gladly answer it. There are a couple of ways to exploit the size factor. The long-standing offering we've had in that space has been the equally weighted top 40 index, which we do have a product tracking, the unit trust tracking that. Now, that's one form of size which essentially diversifies and equal weights your large cap stocks. So you can think of it as an anti-mega cap strategy, not necessarily giving you exposure to the smaller companies available in our market. So another way of taking a size tilt in addition to Smart Core would be to combine it with our mid-cap index fund. So we track the mid-cap index. So you could just have an allocation to that as a blend on the side. But, if the client has got significant scale and would like a bespoke strategy, is able to run that on a segregated mandate basis, we could certainly include size as an additional input into the multi-factor signal that we calculate, and then construct a signal on that basis.
Great.
So there are lots of different options.
Yeah. Kingsley, from our side, I think we're going to call it a day for at this point in time. Thank you very much for the presentation this afternoon. I really appreciate it, and I think our participants, I think we learned a lot from them, firstly, and then secondly, I hope that they learned some valuable information from us. And then from our side, thank you very much to all our participants who dialed in. Just to reiterate one or two things is we will make the recording of the session available afterwards, as well as Kingsley's presentation. We're going to ask you another 2 polling questions before you exit, so please stay on and complete those, because it does provide us with valuable information. And then we look forward to engaging with you very soon. If it's via webinar, that's the way it is currently. Obviously, we would like to have a cup of coffee across the table from you, but at this point in time, it's not allowed or not possible. But once again, from our side, thank you very much for your time this afternoon. And then secondly, thank you very much for your support during this very volatile period. And I think Kingsley wouldn't mind me saying that we had a very good and strong first quarter with regards to inflows into the Satrix capabilities. Once again, showing that there's value and that investors do start to allocate towards us, and it's not only the pricing factor that comes into play. I'm very happy about getting that message out of this afternoon. I do acknowledge there's 1 or 2 additional questions that we didn't manage to answer this afternoon, but we will engage with you, the participants, in person, because we know who you are, and we will engage and then make sure that we answer your questions. But thank you very much for a very active session this afternoon around index tracking capabilities. And from our side, till we meet again, thank you very much, and stay safe.